Welcome to the deep dive. Today we're unpacking the Coinbase Q3 2025 results. Lots to get through. Our mission: pull out the key insights for you from their latest report and guidance. Let's dive right in.
Yeah, it was a really strong quarter. You can definitely see the acceleration compared to earlier in the year.
Big time. For anyone watching the crypto market, this really shows the recovery has legs, right?
Exactly. And it shows Coinbase's model is diverse enough now to actually capture that upside effectively.
Okay, let's hit those top line numbers first. Total revenue came in at $1.9 billion.
Which is a big jump, up 25% just from Q2.
Huge quarter-over-quarter growth. And profit, net income, was $433 million.
And Adjusted EBITDA, $801 million.
Right.
These aren't small figures. Shows real profitability when the market cooperates.
Definitely not vanity metrics, but what about the underlying activity, the users?
Right, so monthly transacting users, MTUs, they climbed to 9.3 million. That's up 19% from Q3 last year.
Solid growth there. And assets on platform, AOP.
That's maybe the most eye-popping number,
Excellent.
$516 billion.
Wow. $516 billion. That's, what, almost double year over year?
Yeah, up 95%. It really speaks to their dominance, especially with institutions. They've become the go-to gateway.
Seems like it. Okay, but looking ahead, the forward guidance wasn't all rosy, was it? Expenses?
No, they flag that. They expect tech and development and also G&A expenses, general and administrative, to actually increase in Q4.
Okay, so costs are going up deliberately. Why? Is it more regulation prep or, like, growth investment?
It seems mostly growth-related. Two main things. Just general headcount increase, hiring people. That bumps up G&A.
Right.
And the big one is absorbing the Deribit acquisition costs for a full quarter. Okay.
That deal closed in August, so Q4 is the first time they'll have those costs for the whole 3 months.
Exactly. It's a strategic cost, part of their expansion, but it'll weigh on margins a bit in the short term.
Got it. And there was another specific warning, wasn't there, about subscription and services revenue?
Yeah, this ties into the wider economy. Even though the Fed has been tweaking rates, Coinbase is saying, look, if interest rates generally keep falling,
Which they have been, somewhat.
right, if they keep falling, that subscription and services revenue stream could take a material hit.
Because a lot of that comes from yield on customer assets, stablecoins, fiat.
Precisely. Lower rates mean lower yield for them on those holdings. So that part of the business is quite sensitive to macro conditions, even if crypto itself is doing well.
Makes sense. Less return on those reserves. Okay, let's pivot then. Let's break down that $1.9 billion revenue number. Where did it actually come from?
Okay, so transaction revenue was the biggest piece, $1.0 billion. That was up a very strong 37% quarter over quarter.
So trading is still booming.
It is.
Yeah.
But who is trading and what they're trading? That's where it gets really interesting.
Wait here. What's the volume breakdown?
Total trading volume was $295 billion.
Yeah.
Now listen to this split. Institutional volume, $236 billion. Consumer volume, just $59 billion.
Whoa. So institutional is 4 times the size of retail.
4 times. Yeah. I think a lot of people still picture Coinbase as mainly for, everyday folks speculating.
Clearly not the whole picture anymore. What does that institutional dominance mean for the business long term?
It points towards, more of an enterprise focus. Institutions mean bigger, maybe more stable volumes. Good for predictability.
But usually lower fees, right? Tighter margins.
That's the trade-off, generally.
Yeah.
Institutional business often comes with fee pressure. So Coinbase seems to be prioritizing locking in those massive asset flows, getting that custody business. Even if the per-trade margin, the take rate, is lower, they're aiming for scale and stability.
Okay, that's a really important shift. Now, within that trading volume, what about the assets being traded? Bitcoin's share went down.
Yeah, quite significantly. Bitcoin transaction revenue fell from 35% of the total in Q3 last year to just 24% this quarter.
And Ethereum?
Ethereum picked up some slack, went from 12% to 17% of transaction revenue.
Okay, but that doesn't fully explain the drop in Bitcoin's share. What else grew?
Well, this is the diversification story. XRP had a huge jump.
Really, XRP?
Yeah, its share of transaction revenue went from 6% last year to 14% this quarter. Big leap.
Wow.
And then you lump in everything else, all the other crypto assets. Yeah. That category now makes up 38% of their transaction revenue.
So almost 40% comes from other coins now.
Right. So think about it. Bitcoin's share dropped, but total transaction revenue still surged 37% quarter over quarter.
Meaning that growth had to come from Ethereum, XRP, and that big basket of other assets.
Exactly. That diversification is what's driving the trading revenue growth right now. It does expose them to more individual altcoin volatility, maybe, but it proves the multi-asset strategy is working.
Okay. And the other side of the revenue coin, subscription and services, that was $747 million, also solid growth. What powered that, especially with the interest rate headwinds we talked about?
The main driver there was stablecoin revenue. Essentially, people were holding much higher average balances of USDC on Coinbase, both on and off the platform where Coinbase earns revenue.
So even though the interest rate they earned might have been lower?
The sheer volume of stablecoins they were earning on was so much higher that it more than offset the lower rate. It's a volume game.
Interesting. More USDC parked there gives them a huge liquidity base to earn from.
It's a key part of their model now. Volume compensating for yield compression.
All right, let's shift from the P&L to strategy. They're clearly pushing hard on infrastructure, custody, derivatives.
Absolutely. Assets under custody, AUC, hit a new record, $300 billion. And a lot of that was driven by inflows from the Bitcoin and Ether ETFs, plus corporate buying.
And they custody most of the ETF assets, right?
They're the primary custodian for over 80% of the U.S.-listed Bitcoin and Ether ETF assets. That's huge. It makes them almost indispensable infrastructure for TradFi getting into crypto. It's sticky.
A long-term lock-in. And that connects to the Deribit deal, doesn't it? Buying the biggest crypto options exchange. Fits their everything exchange idea.
It's central to it, and it's already adding to the bottom line. That acquisition contributed about $55 million in extra institutional transaction revenue just this quarter.
So not just spot trading anymore, they're building out that whole stack. You mentioned their 3 phases idea.
Yeah, they talk about phase 1, investment that's trading in custody. Phase 2, financial services, things like staking, rewards. And phase 3, the app ecosystem, building on their base chain.
What are they doing in that 3rd phase, the app ecosystem? Any new products?
Well, one really interesting thing is expanding asset access in the main app. You can now trade over 40,000 assets directly within the Coinbase consumer app.
40,000?
Through integrating decentralized exchanges, DEXs, that run on their base chain. So you get the familiar Coinbase interface, but access to the huge variety of assets in DeFi.
That's a clever way to keep users inside their walls while giving them DeFi access. What about their own premium services?
They finished rolling out Coinbase One Basic, that's the $4.99 a month tier. Gives you 0 trading fees, better staking rewards. They said it's getting good early traction.
So generating subscription fees beyond just stablecoin yield.
Right. And the Coinbase One card, the Amex one with Bitcoin rewards,
Yeah.
that's apparently scaled past $100 million in customer spending since it launched. Little things, but they all pull you deeper into their ecosystem.
Okay, let's look at their financial position. Balance sheet health. They ended Q3 with $15.5 billion in total available resources. That includes their crypto holdings.
Yeah, they definitely bulked up their liquidity. A big chunk of that came from raising $3.0 billion in new debt back in August.
Right, the convertible notes. But they were 0% interest, weren't they? How does that work?
Yeah, 0% convertible notes due in 2029 and 2032. The 0% part works because of the conversion option, meaning the lenders forego cash interest payments now in exchange for the right to convert that debt into Coinbase stock later if the stock price goes up enough.
So Coinbase is essentially betting their stock price will rise significantly. If it does, the debt converts to equity, potentially diluting shareholders but wiping out the debt without cash interest payments.
Exactly. It's a vote of confidence in their own future stock performance. It's a pretty strategic move when you can get that kind of deal.
Shows they believe in the upside. And they also bought more Bitcoin directly for their own treasury, right?
They did. Added about $299 million worth of Bitcoin to their corporate investment portfolio during the quarter. Putting your money where their mouth is, so to speak.
Okay. Finally, we have to touch on the regulatory elephant in the room. There was some good news earlier this year.
There was. The big SEC lawsuit that was filed back in 2023 that was formally dismissed with prejudice back in February 2025. That was a significant win, cleared a major cloud.
Huge relief for them, surely. But that's not the end of the legal story.
No, unfortunately not. Legal uncertainty is still a major risk factor. There's still the Underwood class action lawsuit proceeding.
What's that one about?
It alleges violations of the Securities Act and state laws, basically arguing certain assets are unregistered securities. That case is moving forward into discovery after a court ruling in February. The outcome is still very much up in the air.
So even with the SEC case gone, this other suit is still a potential headache. How does that ongoing legal risk impact them day to day?
Well, beyond just potential fines, this kind of lingering uncertainty can sort of create operational drag. It might make management more cautious about listing new assets, slow down the rollout of new financial products, especially anything touching staking or yield, and it definitely increases costs for legal defense and compliance.
Right. So the big risks remain crypto price volatility, obviously, and this shifting, uncertain regulatory environment.
Those are still the core challenges, absolutely. They add complexity and cost.
Okay, so let's sum up this deep dive on Q3. It looks like a very strong quarter overall for Coinbase. Profitable, growing, and crucially diversifying revenue streams.
Yeah, driven less by retail hype this time and more by that solid institutional base and strategic moves like buying Deribit.
They've really cemented that custodian role and are pushing hard into the broader ecosystem with base and subscriptions.
But it's tempered, as we said, by the guidance for higher costs in Q4 and the fact that these legal issues haven't entirely disappeared.
Right. Okay, final thought for our listeners to consider, based on the data.
Here's something interesting, buried a bit in the balance sheet details. As of the end of September, Coinbase reported $1.1 billion in marketable investments.
Okay, that's a lot. What's unusual about it?
What's unusual is that this isn't crypto. It's highly concentrated in a single recent IPO, a traditional stock market investment.
Huh. A crypto exchange holding a big, concentrated position in a newly public tech stock.
Exactly. And because it's a recent IPO, they're subject to lockup restrictions. They can't easily sell most of it until late 2025 at the earliest. It's illiquid for now.
So they're exposed to traditional market volatility in a concentrated way they can't easily manage.
Right. They even noted that a 10% drop in the value of just this one stock could cost them over $100 million on paper. So the question this raises for you to think about is,
How might this new, concentrated, illiquid risk in the traditional stock market affect Coinbase's decision-making? Does it change their risk appetite elsewhere, maybe in their core crypto business, knowing they have this other vulnerability they can't easily hedge or exit?
it definitely adds a new layer to their overall risk management puzzle, something we haven't seen from them before.